Morning Doctor and Meishi from Group 1. Actually, we want to present about the financial ratios analysis for the decision making, like for the Big 5 activities, which is 5%. And now I want to present about the questions one. The question which compare the Amazon also for RMS returns on equity like using the third party framework. One is the breaking down the rules about the driver of the each company profitability. So actually for the first one which the Third-party analysis is revealed that the Amazon's ROE is primarily driven by the higher profit margin, actually latest due to the profitable like AWS divisions, along with the moderate like the financial legal rate. And in constant, the Redman's ROE also is rated on the higher asset turnover, like Ethereum is reflecting the operational also for the effectiveness and the economics of the sketch in the lower margin and is which the high value reduced model supported by the higher financial leverage. Actually, the Amazon strategy also is which focus on the this one's high margins business to boost the profitability, while the management is also is focused on the assets flexible, also reach the effectiveness and strive to maximum the return. Actually, it differs like highlight their instance business model and strategy priority which the Amazon is learning towards the technology service and the Wasma is excelling in the traditional retail operations. And also we continue for the questions too. The questions will be how does the Amazon also for the remark in difference in terms of the assets utilizations like based on the asset turnover also for the capital intensity ratios like actually what's the strategy insist can be drawn from this the comparison. Actually we can find that the asset turnover also for the capital intensity ratios also is highlight the contexting the strategy of the Amazon also for Walmart. Actually the Walmart is demonstrate the higher asset turnover like effectiveness like generate more sales per dollar of assets like through its the extensions physical stock. Actually it will also the we want to optimize the supply chains and also for the low cost operational model. Actually it will reflect that it's focused on the operational excellence also for immediately the assets effectiveness. Actually at the other side the Amazon lower asset turnover stem like is from is the higher investment strategy like including the massive like spending on the fulfillment centers like delivery network, also for the AWS like data center, but the Amazon's capitals like is the intensity is higher because it shows that the less renovate per dollars of the physical assets like if you underscore durable long-term focus on the scalability innovations like also will bring out the resist like um flexibility. Actually, the one most also primary is focused on the immediate return on the assets, like we're not driving the sales through the rapid inventory, turnover also for the assets RPT, and also for the Amazon's however, the invest the hurry to execute the future of the markets, like very important across the multiple sections like e-commerce, also for the crowd like competing. Like for the example, the Walmart strategy also we focus on the cost effectiveness like operations, while the Amazon strategy also centered on creating the future growth opportunity like with both the ways it align with the broader visions for the sustainable success.
Compares Amazon's digital and Walmart's physical retail models using 2020 to 2021 financial data. Amazon outperformed with 78% stock growth versus Walmart's 23%, driven by high margin AWS services and efficient operations. It achieved 27.4 ROE through light asset strategies and superior cash management. Walmart generated higher revenue but with lower margins, demonstrating stable scale advantages and consistent inventory performed from for 16% ROE, while Amazon employs growth-oriented leverage. Walmart maintains conservative strategies. Amazon builds physical presence as Walmart's accelerate digitalizations. Findings show Findings show that digital models create value premise while physical retail maintains efficiency. Digital firms should preserve teach leadership while traditional retailers must accelerate transformation. With both strategies supply chain, the retail industry is clearly evolving toward integrated online officially models, requiring further longitudinal research. This study compares Amazon and Walmart's short-term liquidity using 2020 to 2021 data. Amazon shows better financial health with current ratios of the 0.93 and 0.76 versus Amazon Walmart's 0.89 and 0.24. Amazon's strong liquidity comes from its diverse business, especially AWS cloud services and good cash management. Walmart relies more on inventory, which hurts its quick ratio. The findings suggest the companies should first diversify their business, second, manage working capital well, and second and third, check their finance before making big plans. Amazon's digital models works better for short-term financial than Walmart's physical stores. Both companies can learn from each other. Amazon's needs stories, Walmart's need better digital services. Future research should study how different business types affect long-term financial health.
Okay, now I will present a financial risk assignment comparing Amazon and Walmart. First, financial leverage and debt to equity ratio are crucial indicators when evaluating financial risk. Amazon shows a high financial leverage around 3.2 times and a debt to equity ratio of approximately 1.6, while Walmart maintains low rating about 2.9 and 1.2 respectively. These figures suggest that Amazon faces greater financial risk, particularly in economic downturns, although its benefit and from devised for revenue stream like AWS incorrect. Walmart's conservative structure ensures stronger financial stability and low burden of debt servicing. Strategically, investors who promote stability and low risk may prefer Walmart, whereas seeking higher returns might be more inclined towards Amazon. In conclusion, the financial strategy of Amazon and Walmart reflect distinct risk research profiles, offering different options based on investor performance and corporate financial policies. Moving on to leadership recommendation for managers capable of technology investment. Successfully overcoming such as captives require adopting an adaptive and learning-oriented leadership methods. Leaders must base on their decision on evidence rather than historical basis of fears. At the management level, it's important to balance risk awareness with recognize to the transformative opportunities offered by technological innovation. Analytical curiosity and diversification across technology sectors should be encouraged with investment teams. Furthermore, structured risk assignment and controlled policy investment are recommended to build internal knowledge and confidence in the sector. To conclude, effective leadership in the context means embracing change, promoting informed risk-taking, and maintaining readiness for long-term innovation trend.
Hello everyone, I'm Sun Haohao. This part is about balancing strategies between innovation and traditional financial performance indicators in long-term investment decisions, and discuss how to scientifically evaluate and take into account these two key elements in the investment process based on the comparative case of Amazon and Walmart. In the current economic environment, corporate innovation has become the core force driving long-term growth, while traditional financial indicators reflect the short-term business soundness. With a tech company like Amazon, it's easy to overlook its future potential by relying on financial metrics. Therefore,
investment decisions need to find a balance between innovativeness and financial soundness to avoid decision bias. This is preciously the question at the heart of the discussion. To achieve this balance, five core strategies can be summarized. First, to build a multi-dimensional performance evaluation system. Second, prioritizing long-term growth potential. Third, use scenario and sensitivity analysis to deal with uncertainty. Fourth, dynamic settings of investment standards. Fifth, continuous dynamic monitoring and adjustment. Next, I will elaborate on each one. First of all, multi-dimensional performance evaluation not only examines traditional financial indicators but also introduces innovative indicators such as R&D investment and customer growth to comprehensively evaluate the enterprise potential. Second, give priority to long-term growth potential, focusing on potential market space, technical barriers, and the future industry position of the enterprise, rather than just the short-term profits. Thirdly, scenario analysis and the sensitivity analysis are used to simulate enterprise performance under different environmental changes so as to better quantify potential risks. Fourth, dynamic investment standards are very key, and the weight requirements for probability and growth should be flexibly adjusted according to the development stage of enterprise. Fifth, it's necessary to establish a continuous dynamic monitoring mechanism to regularly track the progress of enterprise innovation and market changes to ensure that investment strategies keep pace with the times. So, in conclusion, only by achieving a dynamic balance between innovation potential and financial soundness can long term and high quality investment returns be achieved in the complex and changeable market environment. Thank you.